Japan holds $1 trillion in U.S. Treasuries, and China holds $759 billion. That's over $1.7 trillion in U.S. debt held by two nations. This means that the United States depends on countries like these to keep its finances running. What happens if they start selling? It's already happening, and not just them. Countries like Brazil, Canada, Norway, and India have also sold off huge amounts of U.S. Treasuries very recently. This isn't just a dip in confidence. This could trigger a full-blown economic crisis. So what's behind this massive move? Many believe it's retaliation triggered by America's harsh foreign policies caused by Trump's tariffs. If more countries follow, we're not just talking about a recession. We're talking about the very foundation of America's economic dominance being shaken. What's really going on, and why is this so important? Let's break it all down. But first, make sure to subscribe and hit the notification bell so you don't miss future updates. Let's get into it. The United States government is borrowing money at a record-breaking pace, and this is creating a big problem for the country's financial future. Right now, the total U.S. national debt has reached an enormous $36.2 trillion as of March 2025, and the Congressional Budget Office projects that the national debt will continue to rise, potentially reaching $37 trillion approximately by July 28, 2025. To cover this debt, the government sells Treasury securities, basically official promises to pay back money with interest. These are bought by both American and foreign investors because U.S. debt is seen as a safe investment. Countries like Japan and China buy U.S. debt to help keep their own currency stable and make their exports more affordable in global markets. By holding U.S. debt, they make sure their extra money is being used wisely, earning interest instead of just sitting idle. This also helps them manage their foreign currency reserves. However, this creates a situation where the U.S. government depends heavily on foreign investors to keep its spending going. If these investors ever stop buying, or worse, start selling off their U.S. debt, it could create a major financial crisis. Looking at the numbers, as of March 2025, the U.S. national debt stands at $36.2 trillion. Of that, $7 trillion is what's called intragovernmental debt. Money the government owes to itself, such as to the Social Security and Medicare trust funds. The remaining $29 trillion is public debt, which includes money borrowed from both American and foreign investors. Foreign investors, especially governments, have played a big role in financing the U.S. over the years. In 1970, foreign investors only held $14 billion in U.S. debt, making up just 5% of the publicly held debt. By December 2023, this had jumped to a massive $8 trillion, accounting for 29% of all public debt. This shows how much the U.S. has come to depend on other countries to keep its economy running. But a troubling shift is underway. Foreign investors are now selling more U.S. debt than they're buying. In January 2025 alone, they offloaded a net $13 billion in U.S. securities, on the heels of an even bigger $50 billion sell-off in December. Canada led the charge, marking a significant departure from its usual role as a reliable U.S. debt holder. What's fueling this trend? Rising political tensions and fears of future U.S. sanctions are pushing central banks to diversify. Instead of U.S. Treasuries, they're turning to safer, more politically neutral assets, like gold. This shift is dangerous for the U.S. economy. If fewer countries buy U.S. debt, the government will have to offer higher interest rates to attract buyers. This will make borrowing more expensive and increase the overall debt even more. Higher interest rates will also hurt businesses and consumers by making loans and mortgages more costly. On top of that, if the government spends more on paying back debt, there will be less money for important things like education, healthcare, and infrastructure. Another issue is that during the COVID-19 pandemic, the Federal Reserve bought a huge amount of Treasury securities to help stabilize the economy. This was helpful in the short term, but now the Fed is trying to reverse this by selling off some of these securities to fight inflation. If not handled properly, this could add more stress to the economy. Recent TIC data paints a troubling picture. Following the 2024 election, foreign holders began a large-scale sell-off of U.S. debt. This wasn't just a temporary dip. It marked one of the most significant pullbacks in foreign-held U.S. securities in recent history, signaling a growing global reassessment of U.S. Treasuries as a safe haven. Between November 2024 and March 2025, many foreign countries and big financial institutions sold off billions worth of U.S. Treasury securities, which could amount to about $390 billion over the months, a move that could shake the foundation of the U.S. economy. This was not a small, random event. It was a massive, coordinated shift that raises serious concerns about the future of the U.S. dollar, America's financial stability, and its role in the global economy. Japan sold $27 billion worth of U.S. Treasuries. China reduced its holdings by $9.6 billion, bringing them down to the lowest level since 2009. The Cayman Islands cut their positions by $14 billion, and Canada became the largest net seller at the start of 2025, offloading $28 billion. What's especially surprising is to see Canada on this list, as it has always been a reliable U.S. partner. But with Trump's return, relations between the two countries have sharply deteriorated. Even close U.S. allies like the United Kingdom, Singapore, and South Korea reduced their holdings, showing that trust in the U.S. financial system is weakening. Even though their reductions were smaller, the fact that they participated suggests that this was a worldwide decision rather than separate actions by individual countries. But why are countries selling the U.S. debt? At the center of this crisis is one big issue: a growing lack of trust in the U.S. government's ability to manage its debt. In early 2025, U.S. lawmakers had trouble agreeing on a budget. This scared investors around the world, making them worry that the U.S. might default on its debt, meaning it could fail to pay back its loans. Even though this was unlikely, just the possibility was enough to trigger a global reaction. Another major factor was the ongoing trend of de-dollarization. Countries like China, Russia, and even some European nations have been shifting away from using the U.S. dollar in international trade. Instead, they are making deals in Chinese yuan, euros, or other currencies. Central banks across the world have also been reducing the amount of U.S. dollars they keep in their reserves. This shows a clear shift away from American financial dominance. The effects of this sell-off were immediate and serious. The U.S. bond market became unstable, forcing the Federal Reserve to step in to try and control the situation. The value of the U.S. dollar weakened in global markets, which made imported goods more expensive and increased inflation. The U.S. stock market also fell sharply because investors became nervous about the future of the economy. Even more concerning is the possibility that this sell-off is only the beginning. So what happens next? If the U.S. government does not take quick action, this could turn into a major financial crisis. The U.S. must either find a way to reduce its massive debt or restore confidence in the dollar before the situation worsens. If it fails to do this, America's financial power could begin to collapse. Donald Trump's return signals a renewed focus on trade protectionism. His administration is bringing back heavy tariffs, which will impact global supply chains. Companies that rely on international trade now have to rethink their business strategies. Emerging markets that were hopeful about stronger economic ties with the U.S. now face uncertainty, as Trump's policies prioritize American businesses over global partnerships. One of Trump's boldest and most controversial moves is his new reciprocal tariff policy. Starting April 2, 2025, the U.S. will impose tariffs that match or exceed those of foreign countries. The goal is to level the playing field and make trade more fair for America, but in practice, this policy is likely to spark serious problems. American consumers could face higher prices on everyday goods, from electronics to cars. Meanwhile, businesses will see raw material costs rise, forcing them to either pass those costs onto customers or absorb the financial hit themselves. Even U.S. manufacturers Trump claims to protect aren't safe. Retaliatory tariffs from other countries will make American exports more expensive, slashing overseas sales and shrinking profits, hurting the very industries this policy was meant to help. The global response has been swift. The European Union has already announced plans to introduce countermeasures. China, one of America's biggest trade rivals, may limit exports of rare earth minerals, critical materials needed for U.S. technology and defense industries. Canada and Mexico, America's closest trading partners, are also concerned about changes to trade agreements, which could damage North American economic ties. If things escalate, the world could see another trade war, similar to what happened during Trump's first term, which shook stock markets and slowed global growth. Beyond trade, Trump's policies could weaken global financial organizations. The World Trade Organization, already struggling with credibility, faces more challenges as Trump questions its authority. The International Monetary Fund, IMF, and World Bank, both traditionally influenced by the U.S., might lose power as countries look for alternative financial systems. Meanwhile, China's Belt and Road Initiative could gain momentum as more nations turn away from U.S.-led financial systems. If this trend continues, the global economy could shift away from international cooperation and towards economic nationalism, where countries focus only on their own interests rather than working together. Also, China has already put tariffs on important American farm products like soybeans, pork, and corn. This is a big problem for U.S. farmers because China is one of their biggest customers. But China is not stopping there. It has also reduced imports of U.S. energy and technology products. This means China is trying to depend less on American goods and services, which could hurt many U.S. companies in the long run. On the other hand, Russia is deepening its economic ties with China, working towards a financial system less dependent on the U.S. dollar. Trade between the two nations has surged, surpassing $240 billion in 2023, with transactions increasingly settled in yuan and rubles rather than dollars. India, traditionally a strong U.S. ally, is actively negotiating better trade deals with the European Union and Southeast Asian nations, aiming to reduce its reliance on American markets. Meanwhile, oil-rich Gulf nations, including Saudi Arabia and the UAE, are expanding economic partnerships with Asian economies, particularly China and India. The Gulf Cooperation Council countries are also exploring the possibility of pricing oil exports in yuan instead of dollars, a move that could reshape the global energy market. These shifts indicate how Trump's return to the political stage is accelerating realignments in global financial power structures. As for Canada, which is one of the U.S.'s closest trading partners, they are also fighting back. It is thinking about placing tariffs on $155 billion worth of American goods. This is a strong response, showing that Canada is serious about protecting its economy. On top of that, Canada is working on new trade policies to make its own market stronger. If Canada succeeds, it could start relying less on U.S. imports, changing the trade relationship between the two countries. Financial markets are also reacting. Wall Street investors, who typically support deregulation, are now concerned about growing economic uncertainty. The Dow Jones Industrial Average and the S&P 500 are showing increased volatility. Major investment firms have started moving capital into traditional safe haven assets like gold, which has surged 36% over the past year, as well as Swiss francs and European bonds. The European Union isn't standing still. It's preparing its own wave of tariffs aimed directly at iconic U.S. brands, motorcycles, whiskey, farm goods, and more. These aren't symbolic threats. If implemented, they could cripple American companies abroad. Take Harley-Davidson, for example. The famous motorcycle brand could be forced to pay up to 50% in extra taxes when selling in Europe. This means that a bike like the Road Glide could soar to $124,000 in countries like Denmark. That's not just bad news for customers, it's a death sentence for sales. Harley-Davidson could lose a massive chunk of its European market. The U.S. is on shaky ground, and Trump's aggressive trade strategy may only accelerate the fallout. But here's the big question. Is this the beginning of a new economic Cold War, or just a painful reset? We'll be keeping a close eye on how this all unfolds. So make sure to subscribe and turn on the notification bell to catch our upcoming breakdowns. Thanks for watching, and see you in the next one.